Welcome back to Everything Money. Today we talk about the chip maker NVIDIA. We'll go over the financials, do a fundamental analysis, and show you how to transfer their numbers into an appropriate stock price. We'll use our software and the stock analyzer tool to show you what you could be paying for NVIDIA moving forward. We'll head over to Mo and show you the trends and charts if you're looking to trade this company. But first, why should you watch this video? I bring your questions about NVIDIA, their new Omniverse, and how it'll be a competitor to Meta, to a couple guys who own and operate over $100 million in real estate, multiple businesses, in stocks, and they will give us a mindset and a process for investing in a company like NVIDIA. I give you Paul Gabriel.
Thank you, Seth. Please follow us on Instagram, Everything Money Investing. It's our new Instagram account. Also follow us personally. I have adorable dogs. Mo hates his girlfriend's adorable dog, and Seth has an adorable dog. So please follow us there.
Yes.
All right, guys, this is our Everything Money software. More on that later, but here's the 8 pillars tool. We're going to go to NVIDIA. Click OK. So let's go to a max chart. Because here's an example. Oh, I didn't go. I thought it would go back to 2000. I guess not. The last 5 years. Look at this thing, Seth.
Looks a smidged overpriced.
Well, we don't know yet.
You're right. We could have an explosion of revenue that
Remember,
would cause this.
Price is what you pay. Value is what you get. There's a big difference. We want to make sure that value's here and price is here. That's what we want to make sure. I'm like, wait a second. We want higher. Yes, great. All right, guys. So this is an $822 billion company. This is the trillion-dollar company that nobody ever really cares about. Our first pillar, we want the 5-year PE to be under 22.5. 189.
Ain't nobody got time
Smidge
for
high.
that.
Pillar number 2, we want the 5-year return on invested capital. The invested capital in business is through debt and equity. So we want to see the cash flow return over the last 5 years on that debt and equity being greater than 9%. It is 13.7%. That is a check mark. So they're doing a good job creating cash flow off the invested capital within the business. All right. They have a very small dividend, so small that it says it's 0.0% of the business, 0.0% of the business market cap. It's $397 million. I don't know if they eliminated it or whatever, but this is paltry because the last 5 years and last year they did $4 billion in free cash flow and $7 billion in free cash flow. So they're eating up less than 10% of their free cash flow in the last 5 years on their dividend. So it looks pretty good there. So far, this screams overpriced. The 5-year PE is 189 and last year's PE is 100. Okay. We're here to analyze the stock.
Yes.
See if the growth potential can justify the stock price. So pillar number 3, we want to go to the income statement on our exclusive software.
Revenue growth over the past 5 years.
Correct. So we go to the last 5 years. We go 8.98 to 24 billion.
Pretty good.
Yes. Look at these revenue numbers. 4, 4, 4.5, 4, 8, 6, 9, 12, 10, 15, 24. Were there acquisitions along the way? I don't know. But these big jumps on companies this size makes me immediately think about acquisitions. So to skip ahead, I go to the cash flow statement. I scroll down to the investing section. I see acquisitions and dispositions. And actually, there's only been one acquisition in the last 10 years. Yeah. That was last year. That was a big jump in their revenue. So I want to focus on the organic growth within the business, not acquisition growth, okay? It looks like they had good organic growth until last year when they bought this big company. So that's good. And we want to make sure that keeps going forward. So if you decide to look into this company more for buying it, you want to understand what they bought, and what the plan was for there, and what's the future plan for acquisitions. Pillar number 4, we want net income growth over the last 5 years. Seth, can you guess if it's going to be a check or an X?
Oh, I mean, in comparison to their revenue, it would definitely be up, right? Would they go?
I would imagine so too.
Tripled.
2.58 to 8.2.
Yeah.
Check mark there. Very simple. Okay. Pillar number 5.
Shares outstanding, Paul.
So shares outstanding is a tricky one because everybody gets confused about this. So guys, shares outstanding, I call this the silent killer of investing. People don't pay enough attention to this. If a company is issuing more shares, they are diluting you. Doesn't mean they shouldn't do it. A company as expensive as this, as overpriced as this, if I'm the CFO, I'm like, listen, let's give these guys what they want. They want the crack. They want the extra shares of NVIDIA. Let's give it to them because we don't have to take on debt then. If a company is selling for a value play, you want them buying back their shares. Something tells me for 2 reasons that this company's shares outstanding are going to be higher. What are the reasons you would think, Mo?
It's kind of hypey. That's number 1. Number 2,
I think the acquisition.
They need the acquisition screams at you?
Well, they did an $8.5 billion acquisition,
yes,
so maybe they
correct,
just
correct,
issued shares.
correct.
Maybe they paid cash for it, I don't know.
Yeah, my other thing is they can, instead of taking out debt, they'll just go and issue shares, and everybody's going to start flocking to them.
Absolutely.
So that's why I think that.
So we scroll to the bottom of the income statement on our software. Oh my God, I actually am surprised.
What is it?
2.41 to 2.5. It's still up, which is an X, but I thought it'd be way higher than that.
Surprising.
Because look, 10 years ago, 2.49. So they're pretty much even in shares outstanding over the last 10 years. They did a big jump here. Wonder why that is. All right, so far we have quite a few X's, right? We have the 5-year PE and the shares outstanding. 2 big X's there. Pillar number 6. Now, pillar number 6 has to do with debt. So we go back to our main metrics page on our exclusive software. We scroll to the 5-year average free cash flow. We take that number, we multiply it by 5. That is 21, let's call it $21 billion. We want their total long-term liabilities to be under $21 billion. Very simply, because, Seth?
Well, if a recession hits or a product like their Omniverse doesn't take off very well, they want to make sure they have enough money in the bank to withstand a barrage of losses, perhaps.
Yeah, and we don't want their creditors to come to them and say, pay us up right now and cause more financial problems for them. That's a possibility. So companies with less debt will last longer, just like humans with less debt will stay out of bankruptcy much longer, right? So we take that $21 billion, we go to the balance sheet, we scroll all the way down to the bottom. Total long-term liabilities, $13 billion. That's awesome. So
Great.
if their average free cash flow is $4.1 billion, or 4.0, whatever the number was, they can essentially take a little over 3 years and pay off all their free cash flow with just replicating 3 years of the last 5 years. That's it. And last year they did over $7 billion in free cash flow. So far it looks like their funding is good. They're not paying a lot of dividends out, and they're not taking on a lot of debt. Actually, they did take on a lot of debt. That was probably part of the acquisition here. Oh no, why is that? Actually, this year they took on $5 billion more of debt. Ooh, and then 2020 they took on another $5 billion. Actually, their debt's a lot higher from, this probably had to do with the acquisitions, my guess. They probably took on debt to make this acquisition. Okay, so far, 6 pillars, 4 checks, 2 X's, I believe. Pillar number 7.
Yeah, this is free cash flow growth.
So we go to our cash flow statement, like we did before. Free cash flow, I will not harass Seth about this, but free cash flow is cash from operations less your capital expenditures. You can do one of 5 things with free cash flow. Pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back in yourself. This is the true lifeblood of the business. This is what matters the most, is a free cash flow. Cash from operations less the capital expenditures. I have added this line to the software to make the math easy for you, but more on that in a few minutes. We go back 5 years, 2.64 to 7.16, check mark there. Our final metric is we take the 5-year average free cash flow, we multiply it by 20.
Oh, Lord.
This is a starting point for the value of the business.
God.
$84 billion.
Actual retail price?
880 billion?
820.
Okay. Now the funny part is the 5-year PE is 180. If it was 18, that's 1/10 of it.
I see.
It'd be where we want it to be. So unless this company's going to grow like crazy on its own, this is a hard pill to swallow. This is a major X. Now, for all the numbers to make sense to you, we provide the 8 pillars tab for everybody here. And look at this. Apart from their shares outstanding, I'm going to ignore that for right now. Look at these numbers. Look at these numbers. 5-year PE of 188, 5-year free cash flow of 194. If we want it less than 20, it actually makes sense at those numbers, right?
If you're doubting this right now, stay tuned for our stock analyzer tool. We'll do it right now. We'll show you what you should be paying for this and what return you will get if you're overbuying NVIDIA today. So
guys, every investment is the present value of all future cash flow. If I'm going to give you $1 a year the rest of your life, let's say you have 50 years left to live, how much you want to pay for those $50 in the next 50 years? You clearly wouldn't pay $50 because why do that? You're going to end up with the same money, and there's a chance that I might default on you and not pay you. I could die. My business go to zero. Would you pay $5? Probably. $5 to get 50 over the next, absolutely. Would you pay 40? Probably not. It's only 25% return on your money. The whole point is we make assumptions about the future because we don't know the future. And our stock analyzer tool has become so valuable to people because it allows you to make these assumptions and it'll tell you what you should pay based on your assumptions for that stock. So, NVIDIA. Mo, is there any chance, are we very confident NVIDIA will be around in 10 years?
Yes.
So, let's go to a 10-year analysis. You can do 1 to 20. Now, revenue growth. They've done a good job growing organically, right? Mm-hmm. We want to look at organic growth here. They did a big acquisition in the last 5 years that kind of swayed their revenue. But Mo, give me some revenue growth assumptions for the company.
18, 20, 22.
So,
is that reasonable?
What did the company do last year in revenue?
Give me a second. Did 24 billion, 24.27.
That would make the company $127 billion in revenue 10 years from now.
127
reasonable.
Doesn't sound crazy.
No, it doesn't. It's not 127 trillion. Like
no,
we normally see.
Now I will say though, Mo, my personal opinion is starting at 18 is very, very high.
What would you start at? 15?
No, 10.
12?
Like I would do 10. And the reason being is I look at this 10-year number and go, okay, my goal is to be conservative and buy companies that are selling for below the conservative amount. 18 is still a very high number in my opinion. 18% growth. What would their competition? Who's their competition?
Micron, AMD, Intel.
Okay, what's Intel do? What does
maybe.
Intel do in revenue a year right now?
I don't know. What do they do?
78 billion.
78 billion?
Yeah. So I look at that going, okay, is it possible that they're a lot bigger than Intel someday? It's possible. I don't think, to me, that's a low-end assumption, though.
Okay.
Because to me, a low-end assumption should be, okay, it probably keeps its market share, maybe lose a little bit. I don't think it's that. So my opinion is I'm going to change this to 10%.
10 what?
10, probably 13, 10, 12, and 14. 10, 13, and 16.
Okay.
Profit margin. What do you think about the profit margin?
I mean, I assume it should stay consistent with where it's at around that
probably
27 to 30 number.
Okay, so 26, 28, 30. Free cash flow margin.
Same. Seems extremely consistent over the past decade.
Yep. Now, PE. This is where everybody's going to go, you're wrong. I'm wrong then. If you think the PE here should be above 20, 10 years from now, turn off the video. Not for you.
See ya.
Yeah, it's just not for you.
It's either going to be 12, 14, 16, or 14, 16, 18.
Let's do 14, 16, 18.
Okay. Same with price to free cash.
Remember, guys, if you think that 100 should become 50 because it's still a discount from 100, then come by my house. It's $100 million. Oh, wait, I'll give you a good deal. It's only $50 million now.
Cha-ching.
It's still not worth $50 million. 100 multiple for a company like this, I don't think is a reasonable, it's just a hype stock right now. So I also put in 12.5% returns. Why? Because you can invest in an ETF and get 9 or 10% returns. So put yourself some margin of safety and give yourself a reason to buy an individual stock. Get yourself a higher return. Hit the analyze button.
Oh boy.
Yep, look at this. Low end of 50, middle range of 72, high of 105. And it's at 329 currently.
Oh boy.
So this level needs to drop by 75%.
I mean, it sounds insane, but if you just go based off of where the PE is and where the valuation is right now, the numbers do make sense.
Yep.
They maybe sound crazy, yeah, but I don't think they are.
The one metric we always discuss the most is the revenue growth numbers. I tend to be more conservative than Mo on it because I also look at it and go, okay, what percentage of the market will this be? How big will it be, et cetera? So I look at this company to say avoid. Now, do you like their chips? Awesome. Do you like the company? Great. Pay attention to it. But guess what? There will be a time, and let me show you guys an example of a little company we like to call Intel.
Or Micron.
Or Oracle.
Intel.
All of which we said were the hottest tech stocks of the 2000s.
This was NVIDIA in 2000, basically. The Intel was that. And look, 20 years later, it's still lower than it used to be. We bring up this example all the time. Micron, same thing. Cisco, same thing. All these tech companies, the only ones that are worth way more are Apple, Microsoft, and Amazon, basically. And even those ones fell by 75, 80% along the way.
Before they made their charge.
Before they made their big charge. And the reason they made big charges, the business fundamentals got better.
Yep.
They became much larger and much more profitable businesses. So the reason why we made the software back here that you're seeing is our viewers wanted to be able to analyze their own companies without waiting for us to make every freaking video about every company out there. So we made the software. We committed hundreds of thousands of dollars to it. With the software, you can sign up. You get everything you've seen here. You get it all on your mobile phone. So literally right there, you can do all of this on the mobile phone. You get 2 or 3 exclusive videos per day. We actually just got a text from Tim saying, hey, we need more exclusive videos. We're running out. You get access to Seth Moe and I. You get 30 years of financial data. You get the real estate analyzer tool. You get everything that's here on the front page that's coming soon. You get all the tools plus everything coming soon. And most importantly, if you feel like you're alone in the way you think about investing, and that's why you're gravitating to this channel, we have over 6,000 people in our chat talking about investments every single day. You get access to all of those. You can talk about any investment you want, even crypto for those of you who love crypto, even Tesla for those of you morons who like Tesla out there. I think it's a value play. Either way, you can get it all for only 90 cents per day. 90 cents per day. That's all it takes. It can change your financial future. If you just save 1 or 2% per year on your losses or make 1 or 2% per year more on your gains, you will end up with hundreds of thousands, if not millions more down the road. 90 cents a day. 2 ways to sign up, everythingmoney.com or Patreon. Either way gets you access within minutes. The benefit of everythingmoney.com is you don't pay sales tax yet because we're not large enough. So sign up, 90 cents a day, no brainer. I can't believe we're still talking about it. You should be clicking on it right now.
Oh, but this Omniverse coming out, which is the competitor to Facebook's Metaverse, it's a scalable real-time development platform for 3D simulation design and collaboration with Pixar, its technology, yada, yada. NVIDIA is saying that the licensing fees for this would be around $1,000 a user. Multiply that times 40 million creators around the world. We're getting a $40 billion uptick in revenue. What do you think about this platform for being? I mean, I don't think they have the brand that Facebook's going to hold.
They don't have the brand or the community. I'm just going to use, for lack of a better word. I mean, where's NVIDIA going to go? If you go to a normal person on the street that doesn't know anything about the market or tech, they're going to be like, what the hell is an NVIDIA? If you go to anybody in the world and say Facebook, they know what Facebook is. So I think that they should I'm not saying, I mean, who knows what they can end up doing, but they should probably just stick to the graphics card aspect of it.
Maybe.
It's going to be a lot more beneficial to them, but what the hell do I know?
If you're looking to trade, go ahead, Paul, I'm sorry.
No, Mo, but before when Mo's done, I want to show using really high revenue growth numbers how bad the stock is.
Yeah, I tease that. If you want to trade NVIDIA at a quicker pace, Mo will show you the charts and trends. Mo, we are in the sweet spot, if I'm not wrong, are we?
So this is going back to September of...
I'm on the wrong chart.
This is September of 19, okay? And like when we look in here, we see like some movement and stuff, and then we see this. Like this came out of nowhere. I mean, guys, I say this all the time, and I see the comments. You guys get mad that I'm saying that this thing is going to come back to 220. It is. This run up that has happened, especially since this Metaverse thing came out, this is the support level. It's around 220. I'm telling you it's going to fall back down. It happens all the time. It's had a hell of a run. Eventually, this thing is going to turn down and go through the sweet spot and come straight down. So, in my opinion, you should put this on your watch list to go short long term. Don't do it yet. Just put it on your watch list. But something will happen. But in the meantime, come over here to a swing trading chart and just go up and down with it. As it runs up, take advantage of these big runs. This thing will turn and start to come down, and you should grab it coming down because every time it breaks through one of these moving averages, it's just going to fall harder and harder and harder. The other great thing about NVIDIA, it's a stock with a lot of volatility because there's so much volume and interest on it. So you can come over here and trade it on a 15-minute chart. Today was a beautiful short that you could have made intraday. You could have made a couple of dollars right in here, and there's just so many different ways of going at the stock because it has that volatility, but pay attention to it short. If you want to learn those rules, come and join me in the Bid and Ask Nation. Get acclimated with my Trading 101 series. It's a series of videos that walks you through the rules to be a successful trader. My Employed Trader series, I go through 6 stocks every single day and review them with you. Join me for my monthly seminars that I do on Saturdays and the Discord community of 900 people that think just like you. The Bid and Ask Nation is the place to be.
That's our take on NVIDIA. Slightly overpriced at the moment, but we'll keep you updated if it enters our wheelhouse. Again, we want to find good companies and then find them for cheap. Go ahead, Paul. I'm sorry.
I want to do my...
I forgot, but go ahead. Tell me.
That's okay.
Show me the numbers of how absurd this is.
So let's go back to Mo's numbers of 18, 20, and 22% on the revenue growth. Guys, revenue growth drives every single company to bigger valuations. So I'm going to go at that high level there. Analyze. Look at this, guys. Dropped it. 890, 120, and 160 are the values we're getting. Still half the current price. Okay, let's go higher. Let's go 22, 24, and 26%. Analyze. 120, 160, 215. Okay, let's go higher. 26, 28, 30% revenue growth. Not even there yet, guys.
Go to the
150, 215, 290.
Do 40, 42 and a half, and 45.
Oh, it'll be there.
Well, let's see how there it is. I mean, that's insane.
Okay, it's there.
It's there.
Yeah, so the point is, guys, 30, 33, and 35%. We just barely got it.
Yeah.
On the top end. So this company, based on normal PE and price to free cash flow ratios across history, needs to grow at 30+% a year in revenue for the next 10 years. Next 10 years, so that's 1.33 to the 10th power times 25 billion. It needs to do $430 billion a year in revenue in 10 years to justify today's price and get a reasonable return on your money to buy an individual stock.
Currently, it's doing 24.27 billion.
Goodly.
If you believe that's going to happen, that is what you're saying when you buy the stock today.
Mm-hmm.
It could happen. It very well could happen. But if you have 100 of these, you're going to lose a lot of money.
Blowing kisses to the wind. That's our take on NVIDIA. Stay tuned. We'll update you. Fondle thumbs up. Comment below. Watch more videos. We love you.